Welcome to Infinity Capital, everyone. My name is Raj. So, I will be doing a series of auto ancillary company analysis for for this week and the coming week. So, I'm seeing a lot of traction in auto ancillary companies, and with the lockdown easing up a little bit, we'll see, some sort of traction in these companies. Also, there are a couple of companies which are doing very well in terms of profits and sales from the whole auto ancillary group. So we're going to look at them and see what sort of opportunities are there for us to make money in the short term. So today we are going to look at GNA axles. They make axles, shafts, spindles. They make other components as well. So this company was formed in 1947, and they are a pretty well-known name in the axle shafts business. So they make axle shafts. They're pretty well-known name. So most of their revenue, 50, 60, 82% of their total revenue, you know, so 65% of the revenue is coming from North America, from exports. So most of their revenue is coming from exports, and these are the customers: Tafe, Escorts, Mahindra and Mahindra Limited, John Dairy. You know, these are the clients that they are catering to. Other customers are Meritor, Transaxle, Dana Limited, Kubota Corporation. So these are the companies that they are catering to. They are looking to foray into manufacturing of SUV axle shafts as well. So this is the plan that they are working on. So it's a 1000 crore market cap company. I would put it in the micro cap space. So it's a small company. However, if you'll see that there is good amount of institutional participation here. The promoters hold around 67, 68%. 19% of 19-20% of the stock is out to be traded with public. They generated around 31 crores of cash flow last year. The cash flow has from operations has been positive. This is a good thing. On the balance sheet front, we have they have a loan of around 172 crores, so that's all right. It's a capex opex heavy business. So they need a lot of money to working capital and money to run the business. So they most of these companies will have some amount of borrowings. It's not an asset light model, guys. So that's the thing. So this is where it gets interesting. If you'll notice, the profits have almost doubled in the past 4, 5, 6 years. And although their although the profits have doubled past 3 to 4 years, 3 years, their sales have remained pretty much flat. So the benefit that they got was because the Indian government slashed the corporate tax rate in 2019, which you all must be aware of. In September 2019, they slashed the tax rates. Because of that, this company has benefited a lot. Because if you see, the operating profit margins are pretty much the same. But another thing to notice is that they have pricing power, because if you will see, the profit margin is not volatile. It is between the range of 16, 14. So that goes to show that their product demands pricing power. They have a very good command over price. So comparing the past 5, 6 years, in the past 5 years, 6 years, the profits have almost tripled. Since last year, the profits have also gone up. Considering the fact that there was a huge pandemic last year to this year as well, we are pretty much in and out of it. These numbers are very, very good, and that is the reason why I'm looking at this stock. Also, you will notice that the March numbers are very encouraging. Last March, they posted 5 crores of profits. This March, it's 28 crores. December profits are also much higher, and September profits were also much higher. So there was good traction from September, December. So I started looking at this stock from Jan, Feb, because whenever I see 2 quarters of traction, 2 quarters of sustained good earnings, it's most of the times, there is some sort of trend in the earnings. So if it shows up in two quarters, 3 quarters, you can say with a high probability that the earnings going forward are going to be pretty good. On the PE front, the median PE is at around 14, this dotted line. The stock is trading around that same dotted line, the median PE. So we can expect, for it to go to around at least 20, 25. So the highest PE was around just a moment, guys. So the PE is not showing up here, but last in Jan it had reached a PE of 24, right? So the earnings EPS is constantly going up, so we can expect good traction. Currently it is decently valued. It is decently valued, and the valuations can go up from here. When lockdown opens up, everything eases out, sales start coming in, so that can happen. Let's look at the technical front. So what's happening here? If you'll see on your left, you know the 50-day moving average has started trending upwards, 200 days trending upwards, and if you will notice here, basically the stock was consolidating in this range, in this 20% range, and then it broke out. So it has, if you see the volume also, the volume is pretty high on the days it is going up. Very typical technical setup. So if you look here, it went up, went sideways, and now it is trying to break out. So what is the trade analysis here? So I have been buying within this range. So now the stock has seen some sort of traction, it is going up. So if it dips a little bit, I will keep on adding. This is the range, you know it's a good range to buy the stock in. We can extend the range a bit. So this is the range between 390 and 430. This is a good range where one can be picking up this stock. So what sort of upside can we see? So the company is quarter on quarter, the results are coming good. So my expectation is, once the lockdown opens up, the sales will definitely go higher, and we can see more traction in earnings. So we can at least see a 30 to 40% upside in this stock going forward. That's what I'm expecting. At least a 30 to 40% upside going forward in this stock. So that's the analysis, guys. A quick disclaimer: this video is for educational purposes only. This is not a buy sell recommendation. So please consult your financial advisor before buying or selling any shares. Thanks a lot, guys.